Hello there, I'm Aina. Today, my friends and I will be discussing on the finance for small and medium-sized entity. Are you guys wondering what is meant by SME? Well, SME stands for Small and Medium-Sized Enterprise or Small and Medium-Sized Business. Now, what is the role of SME? SME plays a major role in most economies, particularly in developing countries. SMEs account for the majority of business worldwide and are important contributors to job creation and global economic development. In 2005, the National SME Development Council approved the use of standard definition for SMEs in the manufacturing-related services, primary agriculture, and service sectors. The two criteria that takes into consideration of SMEs are number of employees and annual sales turnover. Are you wondering how SMEs were defined in Malaysia? For manufacturing sectors, the sales turnover must not exceed Rm50 million and full-time employees of less than 200 workers. Meanwhile, for services and other sectors, sales turnover must not exceed Rm20 million and full-time employees of less than 75 workers.
How to be categorized as SME?
Well, there are three conditions that need to be fulfilled for a company to be recognized as SME. First, the company is not a publicly listed company in main board in Malaysia, for example Bursa Malaysia or other countries. Second, the company is not a subsidiary of large firms, MNC, GLC, Ministry of Finance Incorporated, and state-owned enterprises. Lastly, the company is not a subsidiary of public listed company in main board in Malaysia or other countries.
Banking or financing is financial assistance served as enabler for SMEs as engine of growth to move up the value chain and create viral effect to the economy.
Little did you know.
Banking institutions is the main source of financing for SMEs, providing more than 90% of total financing. Provisions of SME financing is also complemented by development financial institutions, Bank Negara Malaysia funds for SMEs, and government funds. Examples of financial institutions in Malaysia providing SME financing are Alliance Bank Malaysia Berhad, M-Bank Islamic Berhad, RHB Islamic Berhad, and many more.
Do you need help?
Reach out to our SME financing touchpoints if you are seeking for advice such as Pusat Sehenti for Business Development, Counter Informasi PKS for Financing Access, Agency Counselling and Pengurusan Kredit for Debt Resolution, and many more agencies for specific reasons.
However, SMEs usually have some problem in financing. The first one is lack of collateral, and the second one is insufficient document to support the application. Next is inadequate working capital. Fourthly, lack of access to commercial lending. Fifthly, lack of ideas. One of the big problems is it is difficult to obtain the financing loan from banks, capital markets, or other suppliers of credit. Then, the SMEs usually unable to fulfill the requirement in financing application because of its strict regulation. Then, the commercial banks are more preferred to give financing service to large firms, and small size of company are being problem to SMEs in financing. Next, incomplete range of financing products and service, gap in the legal framework, lack of information on both the bank and the micro enterprise, and also incomplete of accounting and financing statement. This is a lot of financing problem. Can we solve it?
Don't worry. We still have some measures or option to solve it.
Thirdly, the financial institutions should consider to provide financing for microenterprises, with the simple application procedures. And the second is, the financial institutions need to consider a financial gap, so that the SMEs have a potential to grow their businesses further, and able to create more job opportunities for society. Thirdly, the government introduced a microfinance framework, which is an initiative to enhance financial accessibility for microenterprises through banking institutions, development financial institutions, and microfinance institutions. This initiative assists the microenterprises through 3 initiative strategies: identify the appropriate microfinancing product, raising awareness on microfinancing, and lastly to attract the participation of financial institutions in providing microfinancing solutions.
Here is the recent initiative that can be used to help SMEs in financing. We have development and financial infrastructure, financing and guarantee scheme, avenues to seek information and redress, debt resolution and management, and also outreach and awareness programs.
Bank loans are available to finance the purchase of inventory and equipment as well as to obtain operating capital and funds for business expansion. A loan is an amount of money borrowed for a set period with aim of paying back at an agreed date. The repayment will depend on the size, length of the loan, and the rate of interest. The terms and conditions of loan vary with providers and may be negotiable. Advantages of bank loan. First, it can keep control of the company. Unlike with equity finance, where the business issues shares, banks do not take any ownership position in the businesses. Bank personnel also do not get involved in any aspect of running a business to which a bank grants a loan. This means you get to retain full management and control of your business with no external interference. Second, monthly payments are predictable. For small businesses, having a predictable cash flow is important in order to budget accordingly. With a business loan from a bank, the repayments are predictable and rarely fluctuate, especially if the loan has a fixed interest rate. Disadvantages of bank loan. First, tough to qualify. They are very difficult to obtain unless a small business has a substantial track record or valuable collateral such as real estate. Banks are careful to lend only to businesses that can clearly repay their loans, and they also make sure that they are able to cover losses in the event of default. Business borrowers can be required to provide personal guarantees, which means the borrower's personal assets can be seized in the event the business fails and is unable to repay all or part of a loan. Second, long wait for approval and disbursement. Business loans can take some time to process. Even when all the documentation is provided, there is the possibility of the application going back and forth between your banker and the credit team if the approval requires a higher mandate. Once the loan is approved, other delays can creep in, such as waiting for the collateral to take effect or for other terms to be met before the actual disbursement. An overdraft is an extension of credit from a lending institution that is granted when an account reaches zero. The overdraft allows the account holder to continue withdrawing money even when the account has no funds in it or has insufficient funds to cover the amount of the withdrawal. Advantages of bank overdraft. First, you will have flexible borrowing and repayment options, which gives you some freedom to decide how much money you repay each month. And an overdraft tends to be the cheaper option for short-term borrowing, as you may be able to access one that does not charge interest. Disadvantages of bank overdraft. First, fees and interest charged on overdrafts can be high or even more. So, if you go over your agreed limit, which making it an expensive way to borrow. Second, the amount of money you can access through your overdraft tends to be lower than with a personal loan. Venture capitalist is an investor who invests by providing capital and support to SMEs and entrepreneurs for expansion of their business who do not have access to equities markets. Advantages of venture capitalists. First, provide large sum of equity finances. A startup or a small business requires a large sum of money to keep their brand in the market. For this kickstart, the business requires funds and a good amount of cash flow to generate initial momentum. Second, no pledging of personal assets. Raising funds from a venture capitalist does not require to put personal assets as security against the funds raised, such as bank loan. A venture capital investment in the business does not lend to the business. Disadvantages of venture capitalists. First, minority ownership status. The venture capital firm may only invest in the business if the owners are ready to give up 50% or more than 50% of their shareholdings in the business. Depending on the dilution of the shareholding, the owners can easily lose the business management control. Second, no leverage for founders in negotiation. Most startups and small businesses seek funding to meet their needs. In most of the negotiation, the startup do not have the leverage to negotiate. They have an option to either accept the deal or reject the deal.